Welcome back to the clown market, everyone, where bad news is good news and we continue to rip higher going into a recession because all that matters is the Fed balance sheet. We've now got the SP 500 above 4100, but we've coming up to this trend line here today that we've bounced off on the 2nd of Feb, and there's still this overhead resistance zone in the S&P. So there's still a lot of overhead supply on the SP, but the NASDAQ looks to have clean broken out here. We're at new yearly highs today to end the quarter. And the next resistance zone on the Qs, you could say, would be around 340. But we'll dig deeper into the charts later on. And if this is your first time or you're new to the channel, welcome and stick with me through to the end. We're going to go through all the most important data, markets and charts today. And I go through the same process every day after market close. And if you watch every day, you'll start developing a feel for different markets and what's going on, the different themes, new emerging trends, and what can potentially be overbought and oversold. And as always, I'm going to go through 100 different markets and charts for you today to give you real insight and a look at what's really going on out there. But before that, we'll go and check out all the data and latest stories today. Okay, much the same story all week on the heat map here. Pretty green across the board, a lot of breadth out there. Everything except gold miners was up today. And with rates coming off, tech loved it once again. And check out the year-to-date chart performance. And if you look at what the pattern is here, is basically the bigger the box, the bigger the number kind of thing. You look at some of these year-to-date performances in Apple up 26%, Microsoft up 20%, Google up 17%, Amazon up 22%. Then we've got Tesla up 68%, Meta up 76%, Nvidia up 90% year-to-date. Typically speaking, in history, when semis outperform so much in a short period of time, they then underperform for the next 3 to 6 months. We've seen a lot of people jump on the AI hype train today, which I'm going to get into a bit later. But you can see what's underperformed this year: the financial, health, energy, and utilities. So this market's really been held up by mega cap tech. And the question going forward is, are the generals going to lead the troops and they're going to catch up? Or is it going to be like late 2021 when we saw the troops leading the generals and basically the breadth of the market started falling off before all the big stocks came down? So we're kind of having a bit of an intersection in the market here, technically speaking, and kind of tough for a lot of traders and managers to trade and position through this. Over to economic news today. So we saw that core PCE price index come off a little lower than expected, along with personal spending. So that's kind of a little bit of a downward pressure on inflation, and the market liked that, and we saw rates come off. So that's probably what helped stock and tech stocks rally today. Fear and greed bumped up to 49, pretty much smack bang in the middle of neutral now. And by the looks of it, we should be going into the greed mode next week. Over to options, and the calls have been winning this week, and we saw them pile in again today, especially at the top end. If you look at these percentage calls and the put call ratios for all the big stocks, everything except AMC is mostly calls here. And look at AI, up 21% today. C3 AI, 72% of calls. So the meme crowd is loading into the AI train, loading into tech, and lots of people are calling this a new bull market. Dark pools are still supporting this market as well, slightly bullish there. Corporate insiders not so much, still at really low levels. And Fed Fund futures now pricing in a slightly higher chance that we're going to pause at the next Fed meeting. Depositors pulled another $126 billion from US banks, and a lot of that's gone into money market funds. And some of that money could actually find itself into the stock market as well, adding to this rally. And we're kind of walking into a new world here with the de-dollarization inevitable as use of other currencies accelerates. So China and Russia are really trying to rope in other countries to stop using the US dollar, and so far it seems to be working them. They've signed deals with Brazil, Saudi Arabia, and South Africa want to get on it as well. So that's a trend we can't ignore. As much as a lot of us might not like it, we just have to acknowledge that it is happening. And how do we position for that as investors and traders, which I'll get into a bit later on the charts. And here's a chart showing major reserve currencies since the year 1250. And so, again, there is a history that it does change. So the US dollar, while it will still be big and huge for many more years to come, its dominance, and apparently over the last 50 years or so, it's been like 80% of all global transactions. That is probably going to decline. So I'll talk about the effects that's going to have on some markets in the charts. And American stocks have significantly outperformed other developed world stocks. You can see here over the last 15 years, they're outperformed by 225%. So that's a historical record for how much they've outperformed. And we can see periods of time where international stocks outperform as well. So luckily, we've got a lot of ETFs available, international markets, and I've seen research that having an allocation around 30% to international equities can actually lower your portfolio volatility while still keeping the same return. So something to keep in mind here, that US markets are very priced relative to their international peers. And some seasonality data I want to show you is got quite a few signs pointing to that we're going to have a positive April. So here's a chart showing if January's up 5%, typically consolidate at the start and then we'll rise into April and May. And this chart here as well shows if January was up at least 2%, April was positive 28 of those 32 setup years for an average monthly gain of 3%. And again here, this is the performance of April since 1950, then it's improved over the last 20 years. Still a bit high in the past 10 years, and pre-election years, April typically is a really strong month. And we can see this here too. In pre-election year, April is typically high 94% of the time, with average churn of 3.5%. So that is pretty significant and really hard to ignore that. However, that's the immediate short-term setup. The backdrop in the long term is we've still got banks tightening their standards, and that correlates with the recession throughout history if you look at it. So anytime this number's gone above 40%, the percentage of domestic banks tightening, we've always had a recession. You can see back there in 2000, 2008, and even that quick one in COVID. So we're sitting right here now at 44%. So there's a big spread between the credit markets, these bank tightening, and this whole fiasco with the banks now is going to really tighten up lending. And that should help induce the recession a lot faster, and that's what the bond yield curves have been telling us as well. But we'll get more into that later. Let's head on over to the charts. Okay, so as we always do, we'll come back to the main indices at the end of the video, and I'll let you know how I'm positioned and what I think going forward. We'll just go over the international indices now. So I refer to the 50 bar VWAP as the 50, and that's how I determine whether we're in an immediate uptrend or downtrend. So looking at the international indices here, we can see the TSX Canada is now over its 50. The FTSE not so quite. DAX is actually moving up to near all-time highs. Nikkei is well above it. Aussie got above it yesterday, and China got above it but didn't finish above it. And volatility, if you look at volatility, this is volatility 9-day, moving down really low here at a 16 handle. That's the market saying it does not expect much volatility coming up in the next couple of weeks. And the VIX 30-day now at 18, really low. But if we look at the VIX 3-month at 21 and VIX 6-month at 23, they're not getting down to their lows. So the market's saying that there's still going to be volatility in the months ahead. It's just saying in the next month or so, like that seasonality data we just looked at, that April's going to shaping up to be a quiet grinding month higher. Even though we've had realized volatility here, implied at 18% annually, that's bumped up in the last week. The spread on the VIX, implied volatility versus realized, is almost at equal now. So we can see the VIX at 18.69, realized at 18.29. So the market is not pricing in much volatility coming up. However, that can be a contrarian signal. So this is the spread between the front month fixed futures and the second month. And typically when that goes over 1, you've got to be really cautious as the market can be moving into a dive. But when it comes really low, that can also be a signal that it could be a good time to buy portfolio insurance, some puts and hedges. And if we look back here in history, I'll just add on the SP500. When it got really low down here in March 22, we can see the market sold off. Same here at the start of the bear market in late December 21. The spread between the VIX term structure up the front got really low, the market sold off. And the vice versa has been true as well. When it's popped up, the market's popped up. It's popped up, the market's popped up. So we're starting to get low on this spread. So that could be a good time to add portfolio insurance as volatility gets really depressed. This is the MOVE index, bond market volatility. That's come off 135, but the spread between bond market volatility and equity market volatility is still really elevated up there. Put call ratios are around even today, even though we did see for the big popular names and the AI names had a lot of call buying. And over to breadth data, amount of stocks above their 50-day average, 48%. We have seen that jump a lot. So a lot of stocks have been moving back up in this move now. So this move could still have some more legs to it, and the spreads are breaking out as well. Gross cyclicals versus defensive here. Equal weight, not so much. Contrasting to the other spreads, high beta stocks still weak versus low volatility stocks. And here's the growth value stock spread. That's been hard for those of us that are short growth, long value. But if we take a step back onto a weekly chart and we put on the trend candles, we can see this is still in a bearish downtrend. However, it could still move up a little higher against us, and NASDAQ as well. Tech stocks are just really strong this year, especially against the small caps. Small caps still trying to find a bottom here against the bigs. Gold pulled back today against stocks, and bond market volatility quietening down there, and a lot of buying coming back into the risky end of the bond market. We can see high yield really jumped here against treasuries, and with that softer PCE and personal spending data, we saw rates come off a little bit. Got the 2-year at 4.02 and the 10-year at 3.47. But Fed Fund futures still implying that rates are going to stay up there a little bit. Here we've got July at 4.93%, just kind of hitting a bit of resistance here. Same with September and December. So the market's still implying cuts come later in the year. And with those rates coming off, we saw treasuries pop up here today. A nice little jump of 1.5%. And look at high yield. High yield's really performed well in this move up. We're now back above this trend line and above this resistance box that I've been watching here today. So looks like a clean move up in high yield here. Over to the dollar. And so with this new fundamental backdrop of all these other countries like China, Russia, even India, Brazil, and South Africa now, and potentially Saudi Arabia as well, ganging up against the US dollar. They don't want to use it. They want to trade in their own currencies or in the yuan. It's hard to see how that won't have some downward pressure on the dollar if less people need to buy it, supply and demand. The Fed keeps supplying plenty of dollars, we know that's for sure, with their balance sheet. So if less people are buying it, that should put some downward pressure on the dollar in the medium and long term. So if we look at a long-term chart, 6-month chart on the dollar, we can see it's put in this huge shooting star, topping tail, inverted hammer, whatever you want to call it. It's a bearish formation there. And it looks to be confirming lower. So, and relatively speaking, this is going back to the mid-80s. The dollar had got pretty high up here at 110. Long-term average is probably closer to 90. So if that does move back down, which one could expect this is when the US dollars did 80% of global transactions. I can imagine that number is going to move closer to 50 over the upcoming years. And like I said, as much as many of us may not like that trend and not prefer it, it's just hard to ignore what's going on out there, and it's just not a bad idea to think to kind of hedge against that. So if it does happen, you could potentially benefit from it. So a weaker dollar is going to be good for things like commodities. And so that's another reason why I really like commodities. Because commodities, at least the ones we invest in, are priced in US dollars. So a weaker US dollar should add a big tailwind to commodities. And generally speaking, throughout history, if you go into wars and geopolitical tensions, that's another tailwind for commodities. Because when there's wars, commodity supplies and distribution chains, supply chains, and all that gets disrupted, and demand can go up. We saw what happened in COVID with the prices of food and energy. And anyone with spare money is hoarding, is buying a lot more than they need. Especially wealthy people with a lot of spare money, they'll buy up a lot of supplies. So a lot of people have kind of become preppers. And that's what we saw in COVID. Now, you can imagine a global war. A lot of people are going to rush out and stock up on supplies. And that, in tandem with supply chains being attacked, could lead to a huge squeeze in commodity prices. This is on top of clean energy policies also restricting supply of commodities, especially in the agricultural space. So a US dollar under attack, ongoing and potentially new wars, and people hoarding commodities, and the commodity stock ratio being at all-time lows. This all makes for a compelling case to be long commodities. And even though I'm positioned long commodities in a lot of my portfolios, that doesn't mean that it's just a linear straight move up higher. We're going to have periods of time, weeks, months, where the trade goes against us, and it could be a good time to buy the dip and add to it. And times like now, where we're just seeing cyclical tech stocks rally, and today commodities not doing as well. So this is a long-term trend to play out, but we do have the commodity index here back above its 50. Gold had a little pullback here today, but it looks to be forming a classic bull flag here in the gold futures. And if we just zoom out to a 3-month chart, add the log on that, you can see it's forming kind of a cup and handle chart pattern here, which is a bullish formation. So we're coming up to this all-time high around $2,000 an ounce. And my thoughts is this is going to break higher this year, and I wouldn't be surprised if this goes on a real strong run up to $3,000 an ounce. So I continue to remain bullish on gold. And I feel the same way about crude oil as well. It kind of goes against logic to think that moving into a clean green energy world would see a higher oil price, but I think because of the restrictions on supply of it going forward, and the world will still need oil for many more years, we could see actually oil hit crazy record highs, $200-$300 a barrel, before it finally stops being used, or we deplete it, or whatever comes first. And looking at valuations, the energy sector is still, on an absolute and relative basis, the cheapest in the sector. So I believe all these reasons is also why we're seeing Warren Buffett pour billions of dollars into oil stocks into his portfolio. And food, a similar story. And uranium, as the world kind of backflips its thoughts on uranium. It's actually a really clean energy if it's well set up, not right next to the sea like Japan did. So I think we could see a run higher in uranium as well as most other commodities. Over to the stock sectors, and like I said, green across the board except gold miners. So gold's a good diversifier when it's doing something completely different from everything else. Still haven't got that bounce in the financial sector here. It's looking like it wants to on these strong bullish divergences on our hidden divergence indicator, the regionals as well. And I'll show you, I did a video yesterday of 10 regional banks where the insiders have been buying their own stock, and they're also really cheap according to our indicators as well. So not all banks are going to be completely destroyed. Banks have been around for hundreds of years. They still will continue to be around for hundreds of years. And some of these banks, they operate in real regional areas. Some of them, serve a lot of farmers and traditional industries that don't really even know what's going on in Wall Street, nor do they probably care. So they're not running away with their deposits. And while there's still a lot of problems in the regional banking sector with commercial real estate and the increased cost of funding, and some of the most vulnerable ones still could go under or become zombies, there's hundreds out there. And so I've found 12 that insiders have buying. So I'll go through them with you shortly. But let's just keep looking at the stock sectors here today. So semis didn't get up as much as all the other sectors. You look at discretionary, had a really big move up here today, 2.6%. Clean energy, ARC with all the really high valued stuff moving up 4.8%. And defensives, health managed to kick up here a bit, which has been struggling to do. Staples having a nice run, and utilities strong as well. So defensives are participating in this rally higher. And BlackRock now just above its 50. JP Morgan, like the bank's trying to form a bottom. Mega cap tech, Apple looks to have broken out. Same with Microsoft, Amazon, Google popping back up. Meta at new highs. Nvidia actually reached a new year high today, now up 90% year to date. So it's crazy hype AI train, doesn't look to be over just yet. AMD up a little bit. Netflix still trading strong. And Tesla, look at Tesla today, 6.2%. So you heard me say here, I've been looking at this bullish divergence. We consolidated. I was thinking it's going to resolve. It has, and on above average volume today, on a big Marubozu candle finishing near its highs. So that's bullish for Tesla, and that's bullish for the overall market. And look at meme stocks today. Apart from Bed Bath & Beyond, which looks to be going bankrupt, look at these moves and AI stocks. Big Bear, C3 AI, breaking out to new highs on huge volume. And we saw, 75 or 78% call option purchases. So lots of retail meme traders just piling in on this AI thing. And typically looking back, whenever we see the meme stocks pop, they generally fall over just about every single time after they pop up here. If you go and just look at all these patterns every time they pop up. So generally it hasn't been a profitable trade to join the meme traders at the peak madness. They typically just fall over every single time. However, when there's this momentum in the market, it's hard to tell how far and how crazy it gets. And here's our First Citizen Bank shares that took over Silicon Valley Bank, rallying to new highs today on that great deal they did. Deutsche Bank is holding on, and First Republic, the most vulnerable regional banks, PacWest and Western Alliance, just kind of still sitting down here, not doing much. The big guys as well, trying to form divergences, trying to form a bottom, trying to get above their 50s, but still no luck just yet. And here's this list of 12 stocks that I dug through the sector where I found insiders have all recently, since the Silicon Valley Bank went under on March 10, these 12 banks here, the insiders have been buying their own stock, and they've looked cheap on our stock fair value indicator and have good business quality scores as well. A lot of them are trading at PEs under 10 and still have dividend yields around 3-4%. And if you look on the charts here, a lot of them are forming real positive bullish divergences on our hidden divergence indicator. This stock, Metropolitan Bank, is actually up 33% today. And a hidden divergence indicator, not only is it divergence, but you look at the reading as well. It's gone back into positive territory. So you want to watch when it flips from negative to positive and vice versa. See here it went from positive to negative, and look at the price trend after that. So they're trying to form a bottom here. You can see these tails, the momentum stalling out. There's volume coming in. There's buying the dip here. So I suspect at some point in the near future, we're going to get a huge rip bounce in these banks, especially, the whole sector is not going to go bankrupt. We still might have a few turn into zombies, those real vulnerable ones, and for sure there's still a lot of problems, but out of the hundreds of them, some have got to survive and thrive and come back. And this is what the insiders, the CEOs, CFOs might be seeing as well, and why they're buying their own stock. They see this as a buy the dip opportunity. And in my 20 years of trading, I've just watched corporate insiders time and time again do really well with their buys and sells. And that's because they know the stock better than anyone else on Wall Street. They've been there longer than anyone else, and they're typically really financially savvy people anyway with making good decisions. So I find it pays to follow the insiders, and I'd rather be following the insiders than going against them. Okay, so that's kind of a bird's eye view look at all those major categories, and that's what I go through every day. And if you do that every day, you start getting a feel for where things could be heading and what's happening in the market and the current themes. So let's just look at the SP500 here out on a weekly chart. Come down to this new trend line I've just put in here today, and we're coming up to this resistance zone. So still a lot of mess, so still a lot of resistance to get through, and same on the equal weight SP500. The Qs are a bit different story. They've come off this lower base and look to have broken out. So the NASDAQ looks to have done a clean break and no divergence yet. So this thing could still have a few more legs in it. And we've seen that bullish seasonality in April, and the VIX as well looks to be pricing in that as well. There's just really low volatility up the front here, even though out the back we're still saying it's going to be a bit higher. But looking at the Dow, mid caps, small caps, and even micro caps, we've still got a lot of this overhead resistance. So that could lead us all to, more sideways choppiness, stagnation, price action. And looking at the global net liquidity model, we've got that at 39.64 on the SPX. So there has been a little bit of tapering now. So we're starting to slightly get into overbought territory. But I need to see the S&P 500 get more towards 4,200 and that fear and greed to really go onto greed before we can start calling for a short-term top and maybe tilting net short again. Other than that, looks like a clean break on the NASDAQ. A lot of momentum, a lot of people buying calls here. A lot of breadth, volatility really low. So by all means, this could definitely go higher. And we'll be looking for that divergences and for the S&P 500 to get more closer to 4,200 up until that February 2 high. Might take that out a little bit, overshoot. Then we could maybe start showing some overbought on the fear and greed, and maybe some divergences. Other than that, there seems to be a lot of bullish momentum out there, and that's nothing I want to short into. I had to take some losses today on some shorts in my personal swing trading portfolio, but I'm still positioned market neutral because of the fundamental backdrop, and there's still a lot of overhead resistance in this market. So as I've been saying, I'm going to keep an equal amount of longs and shorts for some time yet. and we'll see how we go next week. Okay, that's all for this week and the end of the quarter. Thanks for tuning in, and if you're new here, hit that subscribe and notification button and you'll get a notification every time I release a video. A couple hours after market close every day, I go through the same process to let you know what's going on in the market, what trends there are, and what could be some new emerging trends, and what looks like could be overbought or oversold. Okay, thanks for tuning in. Have a great weekend, and I'll see you on Monday.